taxes are going to be one of the largest expenses of your life. But the sad truth is that's not exactly true for everybody.
It has revealed the wealthiest of Americans paying little to no federal income tax. Jeff Bezos, Elon Musk, Warren Buffett. In fact, the richest 25 people paying less in income tax than most American workers, and all of it legal.
On the surface, it does seem like the richer you get, the less tax you pay. While this is partially true, it has nothing to do with how much you have or how much you make, but more to do with your understanding of how the tax system works. And the rich have a lot of tax professionals on call to help them figure this out and to reduce their tax legally. But you and I don't. Which is why in this video, I'm going to show you a couple of ways to reduce your tax bill legally and to keep more of that hard-earned money. As a disclaimer, I am a management consultant who have started a couple of businesses and I've had to figure some of this out myself. But I am not a tax or financial advisor. I'm just a guy on YouTube educating you on the possibilities of what can be done to reduce your tax bill legally. But regardless of this information, you should still find out what is relevant for your own country and seek out professional financial advice in the country that you live in. So, how is income tax calculated? When you work, the money you earn is called a pre-tax income. This is what the government looks at to determine how much to take. What's left over is called your post-tax income. Here in the UK and in most countries, taxes are paid in different brackets based on how much you make. So the more money you make, the higher your tax bracket. But this has led to a lot of misconception that the more money you make, the higher you are taxed on your full salary. And quite frankly, there are a few people out there turning down promotions and higher salary because they think they will end up making less money as they move from a lower tax bracket to a higher one. But this isn't exactly correct. The tax bracket uses a progressive system, which means that you get taxed on the next dollar of income depending on what bracket that next dollar falls into. Let me explain. For example, let's say you live in the UK or in a country where we have this tax bracket and your salary is say £100,000. That means you fall into the 40% tax bracket. But this doesn't mean that you'll be paying 40% on the entire £100,000. What it actually means is that for the first £10,000, you won't be paying anything in taxes. Once you've maxed out that bracket, you move on to the next bracket, which means you'll be paying 20% on the next £40,000 until you have maxed that out as well. And finally, you move on to the next bracket, which is 40% until you max that out as well. But in this case, it's just the remaining £50,000. So if you are making £100,000, according to these numbers, you'll be paying a total of £28,000 in taxes. This is broadly how the tax bracket works, but there are some distinctions based on where you live. So you might want to check out your country for what those distinctions are. For example, here in the UK, once you hit a six-figure salary as an employee, you start losing the tax-free allowance, which means you pay even more taxes. Now, running the same number as if you are earning a £60,000 yearly salary, you will notice that your tax bill dropped to £12,000. So, if it's not already clear, what this tells us is to lower your tax bill, you need to lower your income. And the best way to do this is to make sure you are earning money through the right structure suitable for your position. And in this case, we are talking about earning money as a company rather than as an individual. And this largely applies when you have a side hustle or you're doing freelance business or any business in general. When you earn money as an individual, the usual tax process looks like this: get paid, pay taxes, spend money. But if you earn as a business, the tax process changes to this: get paid, spend money, pay taxes. This means you can control the amount of your money that is taxed. And as ridiculous as this sounds, lowering your income is one of the easiest ways to lower your taxes. But obviously, you want to take home as much of that cash as possible. So you need to do this very strategically and legally. For example, I might be speaking to you as an individual, but I am operating as a business. So if I'm getting paid from sponsors or affiliate or even from YouTube, it's all done through a company that I've set up. Speaking to my accountant and tax consultant, I realized that I could further lower my taxes if I bought stuff for my business. And so I did. I bought stuff like this, This and all these purchases cut down my taxes that I have to pay. So if you're making £100,000 a year through your business or side hustle, you can strategically buy stuff that will help your business grow or your side hustle over the long term. There are a lot of things you can expense, but I will encourage you to speak to your tax advisor. Afterwards, you can then pay tax on the remaining amount. And on top of that, the corporation tax rate isn't the same as the income tax bracket we talked about earlier. In most Western countries, it is a lower rate, and for the UK, at the moment, it's about 25%. So as long as you keep this money in the company, you won't be paying any income tax on it. You can keep spending money on business stuff, deducting them as expenses and investing through your company. You can draw yourself a salary, but the moment you do that, that money is subjected to income tax. So the best thing to do is to structure this in a way where you stay in the lower threshold and reduce the overall tax you are paying. And if you are enjoying or gaining anything from this video so far, please do like this video and subscribe to the channel. It helps the channel tremendously. Also, leave a comment on your best tip for paying less tax legally. Another efficient way to pay less tax relative to the amount you make is by earning money through streams that the government view as non-taxable. One of the simple but effective ways to do that is through investing in a tax advantageous account like the stocks and share ISA in the UK or the Roth IRA in the US. This is essentially an investment account that shields your profits and gains from the taxman. It is important to note that this does not reduce your taxable income today, but you get a tax benefit when you try to pull your money out and gains. One of the easiest ways to reduce your taxable income is through the pension contribution. This is called different things depending on where you live. In the US, it's called the 401k. In Australia, it's called superannuation, but it's the same idea. And here's how it works. If you're an employee working for a corporation, you are getting taxed straight away. I mean, as soon as the money comes out of the door, it is getting taxed before you even see it. But with a pension contribution, you'll be able to put a portion of that paycheck away into your pension pot before taxation, and that means you only get taxed on whatever is left. So the end result will be that you pay income tax on whatever is left, and whatever money you put in the pension pot will be invested with tax-free earning. For example, let's say you earn £100,000. If you weren't putting away anything into your pension and assuming no other deduction, you'll be paying £28,000 in taxes using our initial example. But let's say you decide to put £1,000 every month into your pension pot, which equates to £12,000 a year going straight into your pension pot without getting taxed. Now, the taxable income is no longer £100,000, it is now £88,000. So instead of paying £28,000 in taxes, you will now be paying only £23,200 in taxes. This is even better if you have an employer that has a match contribution system, which means for every pound and dollar that you put into your pension, they do the same. This is essentially free money that is also tax-free. But on the flip side, this money is locked away until retirement, which in most countries starts from the age of 65. So, if you are in a position to contribute to your pension and you don't necessarily need that money at the moment, then this is a really good way to reduce your taxable income and therefore reduce the tax that you pay. I can already hear all the alarm bells and whistles and people screaming in the comment, "Chika, I thought you said pay off all consumer debt hanging over your head." Debt can be a major financial burden. If you have debt, make a plan to pay it off as quickly as possible. It makes far more financial sense to pay off any high interest debt, and you would be 100% right, which is why this strategy isn't for everybody. You see, for most regular people like us, debt is seen as a terrible thing. And yes, when it's not handled correctly, it definitely is. But debt is also one of the easiest way to lower your taxes and pay less to the taxman. What a lot of wealthy people do to generate little to no income tax is to take out a loan against their stocks and other high value assets. So let me explain this in 3 simple steps. Let's set this in. Say you have £100,000 sitting in your stock portfolio and you want to access £30,000 from it. But you don't want to sell £30,000 worth of stocks because you have to pay taxes. What can you do? Step 1. Put up that £100,000 portfolio as collateral to borrow £30,000 of your total portfolio value. Now, here's the really cool part. Although you have £30,000 that you can spend however you like, you don't need to pay taxes on that money because that money is a loan. However, you still have to pay back the borrowed money with interest. But generally, the interest on this type of loan can be lower than other type of loans that you are most used to. And that rate can be even lower when negotiated depending on the total amount of asset that is being put up as collateral. Step 2. Unlike most regular people, the wealthy only uses a small portion of this loan money for their personal spending. The rest is invested into stuff that can make more money at a faster rate than the interest that they are being charged for the loan. And this is exactly what you need to do. Don't spend it all on Louis Vuitton and Gucci. For example, if you are being charged a 3% interest on the loan, you could be investing that money in an alternative asset that would yield an 8% return. And finally, step 3. With the profit, you can start paying off the loan, which means in the end you had access to untaxed money. But I can't stress this enough. This is not for everyone. This is a very risky endeavor because if something bad happens, just like we've seen with COVID, you could lose all your collateral. I'd love to hear what you think about these tips for paying less tax legally in the comments. Thanks for watching, and I'll see you in the next video.